expansive tea about what's going on inside Washington, D.C., what regulators and lawmakers are working on and thinking about, and what you and your credit union should be evaluating in terms of risk areas and areas of opportunity. I'm your host, Ann Petros, and Vice President of Regulatory Affairs here at NAFCU, and today I am joined by Dr. Mark Calabria. He is former director of the Federal Housing Finance Agency and now a senior advisor at Cato Institute and a managing director at CETA Experts. Mark is an economist and housing finance expert, and I'm thrilled to have him on the podcast today to talk about his upcoming book, Shelter from the Storm, available on March 14th. And his thoughts on the state of the mortgage financing and housing markets today. So thank you, Mark, for being here.
And it's just such a pleasure. Thank you.
Excellent. All right. Well, let's start talking about your book and some of the wonderful reflections in that book. And let's go back to the start. Can you describe what happened in mortgage markets in 2020? That fateful day in March when we all started realizing that things were headed downhill. And how is this different than the 2008 financial crisis? For example, in the book, you talk about the role of credit risk versus interest rate risk.
I mean, that's a great intro to it. And as a reminder, I was staff on the Senate Banking Committee in 2008 and in the years leading up to 2008. And a theme of the book really is, what were the lessons we took away from 2008 and how things were done well or not well, and how do we make sure we do it better this time? And I think we did. I think compared to, HAMP, HARP, and many of the things that were rolled in 2008, that things went much more smoothly. But to roll back to those crazy days in the beginning of 2020, fortunately, I should say, 2019 was an incredibly strong year for the housing market. We'd seen a fair amount of appreciation. There had been very strong homeownership growth. And I had come into the job at FHFA in April of 2019. And we immediately started strengthening underwriting standards for Fannie and Freddie loans so that when we went into the pandemic, you had fairly strong underwriting. Borrowers were in a very solid spot. And of course, even late 2019, but particularly January 2020, we all started hearing, this talk of a new virus, and none of us quite knew at that time how serious it was going to be, whether there would be lockdowns. And again, even as I think in January, third week, China locks down Wuhan, and even at that point, I think we'd had one U.S. case. So the question of how much was this going to spread here was still on our minds.
Yeah, it still didn't feel real.
It didn't, and that's a fair thing to say. So, for instance, I start out the book, recalling speaking at a home builder convention on the day Wuhan went lockdown, and thinking, well, how's this going to play out? And we had a great housing market. We're trying to fix the mortgage finance system. Again, oddly enough, my speech that day was things are really strong, but we need to strengthen the infrastructure for the next crisis. Of course, did not know the next crisis was right around the corner. Yeah. And then again, as we started to see rumors and more data come out about the virus, combined with some early lockdowns, recall we saw the strongest labor market contraction in American history. Between that March, April, May, 22 million jobs, which again, to put it in context, in the 2008, over the course of that, over 2008 to 2010, we lost about 9 million jobs. So, and that was over about a 2-year time, whereas we had a 2 to 3 month time. And so this was just an astounding amount of pullback in the economy, due to the lockdowns, due to the uncertainty. We saw right away that this was primarily going to be renters. So one of the things we noticed, in March 2020 was only about 40% of the job losses were households with mortgages. So we immediately said, we need to create a bridge. We have learned, unfortunately, over time that for those losing their jobs, it often takes 2 to 3, even 4 months to get unemployment insurance.
Right.
So I hope nobody ever loses their job. And
It's not a quick process.
it is not a good process. And, one of the things I recall in the book, and you may remember this, was, the state of New Jersey put out a call for COBOL programmers to get their UI system working, which was being run in a mainframe basement somewhere. So you're just like, so again, I hope that Congress revisits this and the states revisit this, because what we were primarily looking at this for the household side was, how do we create a 2, 3, 4, 6 month bridge for those families who were going to wait on their UI. And of course, unemployment insurance usually covers about half of workers. So there'd be some that weren't covered. And again, it was all meant to be a bridge. You remember everybody talked about flattening the curve back then. And so our instincts at the time were, we need to get to the summer. And that was really what was set up in terms of the forbearance programs. And we also so we needed to do it quickly. You may remember in 2008, there was a very convoluted paper chase of servicers and borrowers having to fill paperwork, and the paperwork will get lost. And there were even people, whether it was the lender or the borrower, some fraudulent paperwork being filed. So needless to say, it was a mess. And we looked at this and I said right away, we cannot repeat that. No. And I try to be frank in the book about, the gambles we took, if you will. And probably one of the biggest gambles was saying, we're going to take borrowers at their word on the front end. And we knew that would potentially be abused, but we felt that we're going to get you in. The servicer will call you and you'll say whether you've been adversely impacted. And we hope that by asking that question, people would tell the truth. And then our initial plan was to have the servicer follow up about 3 months later. And, are you back on your feet? Have you started working again? Are you getting unemployment insurance? But it really was decided we just could not do this paper chase last time because, again, we'd be too deep into a pandemic that was quickly moving and nobody knew how it was going to evolve. So I do think one lesson that'll come out of this is there's going to be much more pressure in the future recessions and future downturns just to get people in and verify it later. Now, what we saw in the Fannie and Freddie book did not suggest there was a lot of abuse, that we didn't get a lot of evidence that people taking it didn't need it.
Didn't seem like that was the case in the broader market, generally.
Maybe a little bit of FHA, but generally no.
Yeah, not for conventional mortgages.
Conventional mortgages, largely the people who took it seemed to need it, and that's what the evidence suggested. But we knew we had to do it quickly. The other aspect that was really important to me that I took away from the 2008 was the way that HAMP and HARP and many of the assistance programs in 2008 were set up is, they were, means tested, which made sense, but they were set up in a way, and I still to this day don't know where the 31% came out of the air, but most of these programs are set up so that if you lost your job or had a reduction in earnings and you got into HAMP and HARP, every additional dollar you made, you lost 31 cents in mortgage assistance. And then you add that on other things. And again, I'm an economist by training, and I believe these incentives matter. But you had really strong penalties in the assistance programs if you went back to work. And of course, as we all remember, the Great Recession was the weakest job recovery, post World War II.
Yeah, it took a while.
Absolutely. And I think, I'm not attributing all of this to the mortgage assistance programs, but I do think the structure of the mortgage assistance programs in 2008 deterred a lot of people from going back to work, or at least, working on the books. So one thing we didn't look at this, partly because we knew as quickly as the labor market was moving in the spring of 2020 that, any income data would be stale, so the data would be stale, and we didn't want to penalize people for going back to work. So we looked at this and said, again, with that kind of flatten the curve mentality, let's not make this based on, you got to testify you've had a reduction in earnings to get in, but we're not going to make this contingent you staying in on whether you go back to work or not. We'll let you take it, and there'll be no reduction in penalties if you go back to work, because we don't want to penalize you for going back to work.
Right.
And I do think that one of the reasons we've had such a very strong job recovery starting like May, June of 2020, which really continued for most of 2020 and 2021, was because we didn't penalize people in the mortgage programs. They could stay in, and that was a really important difference this time around. So I do think they ended up being quite successful. I was surprised at, consistently we had about a fourth of borrowers who signed up for forbearance and paid throughout. We also had a very large number where people would stay for 3 or 4 months of forbearance and they would mail a check for 3 or 4 months in.
Right.
So it was surprisingly large number of people who took it as a kind of backstop option.
Yeah. And you talk about that incentive for going back to work. I mean, it's
Yes.
one thing to have a penalty on, let's say, a subprime mortgage for, late payments,
Exactly.
right? But this is a very different situation, and people were still doing their best to make payments as they could, but just wanted that safety net.
And that's exactly what it was. And again, unlike 2008, where there was a lot of anger at Wall Street and banks in general, and there was what I would call
There's still some anger at
there's
Wall
some,
Street.
again, and that's there probably always will be some,
You're right.
and there will always be some out there stroking up that anger. But the point being that nobody in 2020 thought that they were having problems with their mortgage because of something the lender did.
Yeah.
So you didn't have this adversarial relationship. And, a lot of lenders across the board, credit unions, depositories, people really reacted quite quickly.
Oh, definitely.
And, one indicator to me that we got it largely right was that the people who weren't covered in Fannie and Freddie loans mostly mirrored what we did. When you had a fair amount we coordinated with FHA, but there's still a large segment, whether it's portfolio lenders or private label. And pretty much, I would say we got 95% of the market with a very similar framework. And again, not everybody had to adopt that. So I see that as some indicator of success. Now that's on the household side, which we can come back to. But 2020, March in particular, we had another financial crisis, to put it frank. And I think it went so quickly that perhaps people had forgotten about it. And obviously there was a lot else going on in that time. And some of this was, as COVID started to develop, you had, starting about December 2019 into January, February, a real move toward safer assets. And when people were selling off corporate bonds and buying treasuries, and for a while they were buying mortgage-backed securities as well. And so you saw that flight to safety. In March, it really became less a flight to safety and more a big dash for cash, if you will. Some of it was a concern that, all these job losses, mortgages might not pay. And of course, mortgage servicing rights, kind of decline in value when you have to service, distressed mortgages. And we also started to see the Fed in March really start to intervene in a very heavy way. There were targeted interventions, some of which we partnered with the Fed on. There were obviously broader interventions of the Federal Reserve. The Federal Reserve, I think, to be quite frank about it, came in very heavy in the mortgage market, in my opinion, perhaps too hard too soon. And the reason for this is you really saw such a dramatic change in interest rates. And you've seen this evolution. And of course, let's all remind ourselves that mortgage-backed securities act like any other bond, except for, of course, the prepayment. But, so when you see these declines in rates, you can see very dramatic changes in mortgage-backed security values. And more importantly, you see even more volatility in mortgage servicing rights, because those are almost completely driven by kind of interest rate risk. And so whereas the 2008 crisis was predominantly credit crisis. It was a crisis of borrowers not paying their mortgages. And that holds true even in the commercial mortgage space and other sectors. The initial shock here, and again, it's not one or the other, it's both, where I would say 2008 was, 70% credit risk, 30% interest rate risk, because again, we saw some changes there. This was really a flip of that, where the interest rate changes engineered by the Fed in March 2020 really ended up with a lot of disruptions throughout the mortgage market. But you certainly had concerns about whether borrowers were going to be able to pay, and that entered the credit risk. You also had the growth of market participants who were much more vulnerable to interest rate changes. And the biggest really development here, in my mind, was mortgage REITs. And of course, REITs are traditionally set up by the tax code as a passive investment vehicle. You're supposed to go out and buy an apartment building and, you get your dividends. And there has developed a small number of mortgage REITs that generally buy mortgage-backed securities, mortgage servicing rights, and they fund them overnight by repoing essentially the MBS. And obviously, that's a very vulnerable, to be frank, it's kind of what Bear Stearns did going into 2008.
Right, yeah, it's a risky business.
So, one of the real things that I think has been forgotten in that middle of March time was you had a number of mortgage REITs where the decline in interest rates just slammed the value of their MBS and their MSRs. And because of the REIT structure where you have to pay out, 90% of your earnings in dividends, the tax structure of REITs punishes you for building equity in the structure. So you have to keep paying it out as dividends. So there's almost, in a sense, a tax penalty for not being leveraged, which of course, Congress again intended these to be passive investment vehicles. So you saw a lot of pressure on MBS selling at that time. Because of post-Dodd-Frank changes in the regulatory structure, there are limits to how much the MBS dealers, many of which are Treasury dealers, many of the same participants, were willing to absorb that. So you had a lot of these REITs that were selling off their MBS. The dealers were buying them. But the dealers are starting to hit their balance sheet constraints on how much they were willing to buy given the capital they had. And this was really what fundamentally drove the Fed into the picture, as well as, we were getting requests from the Fed. I talk about a conversation Jay Powell and I had where, could we have Fannie and Freddie essentially provide, repo funding to mortgage REITs, which we did. Again, it wasn't widely used, partly because I wanted to make sure that the pricing wasn't too overly attractive. We really wanted this to be a lender of last resort. Like, you're really only going to go here because you don't have any other option.
Right.
And so we set that up. And of course, when the Fed started buying MBS in very large amounts, that relieved much of the dealer balance sheet constraints. And then those dealers were able to buy mortgage-backed securities from the REITs again. And so you brought some stability there. Obviously, there were problems throughout, of course, the anomaly, as you recall, was depositories, and community credit unions were generally doing fine. We saw huge influx.
So much cash.
Huge influx, trillions of dollars of extra deposits in the system. So that part of the sector was doing fine. There were some concerned elements. So, for instance, many of the non-bank mortgage lenders who have grown, who have come into play.
There are plenty of concerns there. And I do want to ask you about that and exactly, what the FHFA did in response there. But first, in your book, you say, I quote, "The Federal Reserve has become the buyer, dealer, and lender of last resort in the mortgage market because policymakers, in response to 2008, hobbled the ability of the rest of the market to effectively respond." So explain what exactly do you mean by that, and how can this be fixed?
Not only, it needs to be fixed. It needs to be fixed. And so you would think that given the central role of mortgage finance in the 2008 crisis, that perhaps Washington would have fixed our mortgage market, you would be sorely disappointed and surprised. And 2020 really was a test of that system, where it only survived because essentially of considerable liquidity and support. And so because of a number of post-2008 changes, including Dodd-Frank, but also very aggressive enforcement such as the Fair Claims Act against mortgage lenders, was that you saw a very big shift post-2008 away from depositories, not only holding mortgages, but more importantly, servicing mortgages. So pre-2008, even if you were a credit union or were you were a commercial bank, generally, if you originated a mortgage, you usually kept the servicing even if you sold the mortgage off.
our members always
Yeah.
like to keep the servicing rights.
And I think it's important, when you have a relationship with a financial institution. I talk a little bit. I won't mention the name of the financial institution now, but I mentioned a problem that I had with my own servicing post 2008, where a financial institution that I had a long-term relationship with sold my mortgage servicing off to a non-bank servicer who later failed. And needless to say, and the part of it was most important to me was that non-bank servicer forgot, maybe I should generously say forgot to pay my property taxes to the District of Columbia, who's not.
That can be a huge issue, though.
You can lose your house. Yes,
Yeah.
and so only because I was able to get on top of it and find out, to stop it from getting to a point where there was any threat to have my home foreclosed upon by the city. But again, you don't get the same level. Let's be frank. I mean, you don't get the same level of service.
No.
And so this increase in non-bank presence, non-depository presence rather, because again, I'll put credit unions in the depositories as having that stable reputation concern. And also because you have a whole suite of products that you're working with. There's simply a different approach to the consumer that a depository takes than a non-bank. One of the really big items here that I don't think was as appreciated at the time was you had this huge, 49 AG, and this is, a state attorney general settlement with the largest depository servicers. And of course, this is how Kamala Harris came to public attention when she was attorney general for California. And the problem was that even though you were going after, particularly in response to the robo-signing crisis, there were legitimate concerns, there were legitimate problems. But the problem was that the servicing requirements in the settlement only covered large depositories. And what you saw happen was, in response to that, many of these large depositories simply said, I'm going to get out of mortgage servicing. And they sold record amounts of mortgage servicing to non-banks. And so you saw this huge transfer to the non-banks. And that really kind of set the stage for the problems in 2020, because you had this growing separation of origination and investment from servicing. And partly, probably the problems with some of the mortgage REITs was because they were heavily invested in mortgage servicing rights. And you can. So you also saw capital changes that the financial regulators put in place post Dodd-Frank that really penalized the holding of mortgage servicing rights. Obviously, reputational concerns. I quote, for instance, J.P. Morgan at one point saying that they were getting out of Fannie, Freddie, and FHA servicing because of the reputational hits. And I'm sure they're not the only institution that looked at this and said, I care about my corporate reputation. And as we know, credit unions care very much about their reputation. And I'm not going to say that some of these non-bank mortgages don't care about their reputation, but there's a little less.
It's a different kind of business model.
It is a different kind of business model, and it's a business model where you can close shop one day and set up tomorrow under a completely different name.
Yeah.
And I do think, this should be of a concern as a broader public policy industry question. The reputational penalties in the non-bank mortgage sector are just so much smaller than they are for credit unions and banks, especially credit unions where these are, your customers are your members. So much of the non-bank system, you're just originating, you're selling, you're never really going to see that person again. There's not a lot of reputational business in the same way. And if you, get in trouble and you go out of business, you start up under a different name. So there are a lot of problems there. And going into 2020, so much of the mortgage market, particularly the FHA, Ginnie space, completely dominated by non-banks. And so, it's interesting in that when I walked in the door at FHFA in 2019, one of the first things I said to our senior staff was, convince me that everything we've done since 2008 on servicing will save us next time around, because it very clearly was a weak link before. We, in January 2020, actually at FHFA proposed stronger liquidity and capital standards as counterparty risk. So it's important, important to keep in mind there is no federal regulator for the non-bank mortgage lenders. And what we were doing at FHFA really was just trying to control the counterparty risk to Fannie and Freddie. So we weren't regulators of these institutions. our objective was, how do we protect Fannie and Freddie from counterparty risk, which of course every appropriate business looks at that. Oddly enough, I spent a lot of February 2020 being told by many of these non-banks that, they had fortress balance sheets and didn't need to raise liquidity and capital and they'd all be fine. So you imagine my surprise that a month later,
come March
2020, they're like, "Oh my God!"
different.
Yes, suddenly they're all at
We're
risk.
in dire need
exactly.
of assistance.
The speed with which their story changed. I almost got whiplash. So it was. So all that said, one of the interesting parts of the book to me was, because there was a tremendous amount of job loss, a tremendous amount of forbearance provided. And again, I want to emphasize that the contracts that Fannie and Freddie signed for servicing are very explicit that, you're expected to, advance payments to the investors under certain servicing arrangements. I certainly could say for certain other servicing arrangements, a lot of small credit unions, for instance, will use the cash window. If you use the cash window, you're not on the hook. So many originators, when they would sell where they would even retain the servicing, they could choose a contractual arrangement with Fannie and Freddie where they were not liable to advance payments and interest to investors, even in a stressed environment.
I do recall that at that time, some of our members who, do the MBS swap were very concerned about, the requirement to remit, the principal and interest on the scheduled, or what is it, the actual scheduled.
Actual. So, I mean, there is a conversation in the book about, walking you through, why the differences in these and why they matter. And there was a very legitimate concern, particularly as I mentioned earlier, where we were going to take borrowers at their word. Now, I guess lucky timing in this, in that, I had set up we didn't have a standalone research division at FHFA when I walked in the door. We had one start at the beginning of January 2020. Lynn Fisher at that time, who had come to me from previously worked at MBA and AEI and had a lot of industry experience as well as teaching, had really helped us set up a research shop. And so we were doing a lot of empirical work. And so we had a range of options that we were looking at and saying, this is what we think the labor market's going to do. And therefore, looking at past crises, what do we think forbearances will get to? That said, my research folks at the time should not be held responsible for the fact that I think the third week of March, I was talking to Diane Olick on television, and she's like, "Mark, where's this going to get?" And of course, I'm sure my research staff in the back of their head was like, "Don't give a number, don't make a forecast." And I, felt comfortable enough to say at that time that I thought that, what we were looking at in the job market, that we would probably get around 6% forbearances for Fannie and Freddie by the middle of May, and we got, I think, at 6.7. So it was actually pretty close, but there was a wide range of error with any sort of forecast in that. And you may remember there were people at the time saying that forbearance rates would get to 30, 40%.
Oh, yes. There were projections that really high.
What we were seeing internally suggested that worst case scenarios were probably closer to 15% than 30 or 40. But that said, there was a lot of uncertainty in the marketplace. There was a lot of uncertainty how the process would work. Even pre-COVID, Freddie contracts capped servicer liability at 4 months. And then after that, Freddie would take it over. We were in the process of aligning that for Fannie. So there was a lot of moving parts where we were trying to get the information out there. But needless to say, there were a number of servicers who were asking to have, the Federal Reserve essentially invoke 13.3 facilities to provide financing.
You were a little skeptical about.
I was skeptical, but certainly also I reminded folks, it's not my call. 13.3 is the Fed. The Treasury had to approve. Now, Treasury at that point was heavily relying on us for information. Now, I believe March 2020, there were 346 non-bank mortgage servicers that Fannie and Freddie did business with. We had income statements, we had balance sheets. Generally, those were filed on a quarterly basis. So we immediately got on the phone with the largest ones. And again, that industry is relatively concentrated. We probably in the first week immediately talked to the largest 20 to get updates and said, this is what your last filing was. What's changed?
Yeah, where are you now?
Yeah, exactly. So we had a pretty good sense. And the other thing we were doing as well was asking people how much servicing could you take if we needed to transfer it. And we had just in September 2019, September and October, done a very big transferring of what was in DITEC to New Res and did a very large servicing transfer. There were lots of servicing transfers that were done 2008, like when Lehman failed, for instance. So this was something that Fannie and Freddie had a fair amount of experience at. And so we knew how to do servicing transfers. But we wanted to have a sense of how much capacity did we have. And obviously, you don't go into it lightly because, as I mentioned myself, when I had my own servicing transferred, it didn't go smoothly. So
I've also had a recent experience with that service transfer, and
you don't really want to transfer servicing unless you have to. But that said, if you're transferring servicing away from a failing company to a stronger company, that's probably in some sense better than leaving it at the company that may be failing, because obviously somebody at the risk of failure is probably going to be a little shorter time horizon caring about the quality of servicing they're providing. But all that said, we were monitoring the balance sheets. We were talking to institutions, including depositories, and asking how much servicing could you take. And essentially what we had done would kind of have a circle. We knew how much capacity we had. And we would share that information almost on a daily basis with the Fed and Treasury. We constantly were talking to the Federal Reserve. Now that she's gone over to the White House, Lyle Brainerd was kind of the point with Randy Quarles to a degree, handling the mortgage issues. I do talk about, in the book, that the Federal Reserve had set up a liquidity facility for non-bank mortgage servicers and was just waiting for Treasury to tell them they could turn the key. And, to Mnuchin, to his credit, was very skeptical. He probably didn't need me to provide him the data, but we were sharing the data with FSOC. We were sharing the data with the other regulators. There were a handful, maybe at most, every morning throughout the first several months of the pandemic, I would get a troubled servicer watch list, and we would go through the staff and who do we think we're going to have trouble with. To me, it's probably, I think, perhaps counter to conventional wisdom, but I often say, to me, one of the lessons of Lehman Brothers in 2008 is that if you give an institution reason to believe it will be rescued, and of course Lehman looked at Bear and said, we're probably going to be rescued, that they will drive a hard bargain for assistance. And we know that there were at least 3 offers to buy Lehman before it failed. And each time they said, well, no, that price is too low because we want to get at least what Bear got. And the reason I raise this is, there were, I don't mention the names, but a little bit of Googling and the information I give you in the book, you could figure out who I'm talking about. There were at least 2 large servicers. They had private equity parents. They had they'd literally pulled billions of money out of these companies in 2019. And so, we felt that it was important for these parents to, if they wanted to keep the value of those companies, which was essentially the servicing rights, that perhaps they should put the money back in before they asked the taxpayer to put the money back in. And we had that relayed to them via Fannie and Freddie. And I think, once it got further into April and it was clear that, or rather increasingly unlikely that a facility would be set up, these companies put money back in. And they were their investments. They took money out. They took back in. I believe that's how capitalism is supposed to work. Right. You take the upside, you take the downside.
You had it, and you were able to take care of it on your own.
Exactly. Now, I suspect some of it was, as I say, they probably said among themselves, Calabria is just crazy enough to transfer our servicing if we don't put it back in. So, I think you have to have credibility that you will say, listen, I have an option here, which is to transfer your servicing to someone else. I will do it. And if you want to put money back in institutions that you've taken money out, that's the appropriate response.
You drove a hard bargain, and it seems like it
worked.
Played out.
It did, and of course,
how you thought it would.
One of the fun parts of writing the book was going back and reading some of the press accounts for that time, where people like the Financial Times and others were calling for me to be fired because we wouldn't bail out the servicers. But at the end of the day, I think you have to take a tough approach. I do think that some of this benefited from issue. Secretary Mnuchin had run One West. He had a history in the mortgage industry. I clearly have been, following the sector for a very long time. So you had people at the table who felt that they were fairly literate with the function of the mortgage market.
Right.
And I think had fairly strong opinions. And, Secretary Mnuchin generally was a market guy, let the chips fall where they may. I think some of the other sectors, I remember, so I should say that Secretary Mnuchin was coming into the Treasury building almost every day throughout the pandemic. So I would go there and meet with him. And I remember one day, so I'm walking out of his office, Doug Parker from American Airlines is walking in. And I think some of the assistance provided to airlines and other sectors were just as much because Washington doesn't understand those sectors pretty well. Like, to me, it's probably shocking in retrospect that
It's not surprising.
to the best that I could tell, the Department of Transportation really wasn't at the table for the airline assistance. It was really run through Treasury. Not that DOT tends to have a fairly pro-airline point of view, so not that they would have pushed back, but you didn't even have that. I mean, in some sense, it's shocking in COVID how much of it was driven by Mnuchin and the Treasury Department writ large. And that should be a broader public policy question of how much of these decisions, even the PPP that was, arguably run by SBA.
It was through Treasury.
It was through Treasury, yeah. So, I mean, they really had a very outsized hand. I personally think that, why I may have had some disagreements with, I talked about in the book with Secretary Mnuchin. I think he's underrated as a Treasury Secretary. I think he did a great job.
In a very difficult time. I mean, in some respects, it's kind of nice to have that sort of centralization where the Treasury was, leading a lot of what was going on, because otherwise you can imagine, countless government agencies trying to set up programs and run everything on their own, and that would lead to chaos, really.
And he was viewed, despite, during his confirmation process, taking some hits for his One West, everybody's going to, as we talked about, there were always going to be people who kind of chin up anger at financial institutions. But Mnuchin was viewed credibly on the Hill. He was the primary negotiator on the CARES Act for the administration. And, we provided, even though we were independent, we provided assistance and worked with Congress, on the forbearance provisions, which largely mirrored what we were already doing. So I think a good indicator that we were on the right track. But Mnuchin really was the negotiator and driver of much of the CARES Act, and people viewed him rightly as speaking for the administration. Also, say as an aside, I don't think there was anybody who had quite the knack of knowing when to be around the Oval Office and when not to be around the Oval Office.
Yeah.
He had a good radar. He had a good radar for that.
He figured it out.
And again, there are some issues I talk about and resolve in the GSEs where Mnuchin and I had agreements, and then other areas where we probably had disagreements. But again, I would say I think he's greatly underappreciated in the role he played.
Yeah. Well, you talk about, the growing footprint of non-bank mortgage servicers, and, their expanding market share in Fannie and Freddie between 2010 and 2020. And, do non-bank mortgage lenders and servicers pose risk to consumers and to the stability of the housing market? And should they be regulated to a greater degree, on the federal level? What does that look like?
So, the first part of this question is absolutely. They've taken over this market in a very big way. I think the tough question is that, for me, so much of the regulatory structure has pushed depositories out. And I regret we didn't make progress where we really wanted to do on this front. But in late 2019, we had created an interagency working group where we were working with the SEC, with the Federal Reserve, on mortgage finance reform, because there was only so much I could do, because how the regulatory treatment for depositories really affected this. So I think maybe to kind of in some way answer the second part of your question, rather than subject non-banks to the same sort of regulatory structure we have for depositories, I would rather have us fix the regulatory structure we have for depositories. But, Washington being what it is, the easier may just be, subjecting non-banks to the same playing field. I would
we would certainly prefer that. The
former rather than the latter. But
you've got the CFPB that is in charge of enforcing compliance with consumer financial protection laws in the mortgage space, TILA, RESPA, all of that. And so, there is. I'm not saying there's no regulation and supervision.
There's a whole lot of regulation.
But there's not the same extent of evaluation and examination of safety and soundness.
Correct.
So when you get into a crisis, That's why there were so many concerns, really.
And it is a legitimate concern because if you have a large number of servicers fail, I mean, first of all, I mean, Fannie and Freddie do have backup procedures, but these backup procedures often require the mortgages to come onto their balance sheets. And keep in mind, when I walked into FHFA in 2019, Fannie and Freddie were leveraged 1,000 to 1. We went into COVID probably about 150 to 1. And, it wasn't popular at the time, but because we started charging some fees to offset it, we kept Fannie and Freddie from failing. And because we had built capital. So to keep in mind, Fannie and Freddie combined had about $6 billion in capital when I walked in the door in April 2019. Their COVID losses were in the neighborhood of $5 to $6 billion.
Yeah, that's nothing.
So again, part of the problem is that you have so many weak links elsewhere. Maybe if Fannie and Freddie were in better shape. So for instance, I mentioned there were a lot of calls in 2020 to have Fannie and Freddie essentially rescue the non-banks. And my reaction was, well, A, the non-banks aren't my regulatory responsibility, but what is my regulatory responsibility is Fannie and Freddie, and they may need rescuing themselves. So again, part of this is that we haven't fixed Fannie and Freddie, which is a problem, and so their ability to be a source of strength for others is severely limited. The non-banks, I mean, they don't have the same sort of reputational concerns as you mentioned, even though they are subject to some of the same consumer protection concerns. Of course, they feel them a little less because not only do you have CUPP, but you have your primary regulator regulating those as well, which the non-banks do not have. But ultimately, at the end of the day, and despite what I think are some very sincere efforts by some of the state regulators, you don't have the same sort of. It's not comparable. And again, my hope would be that we find a way to fix this to bring depositories, particularly credit unions, who really, it's not just a one-off transaction with your consumer. Even if you did subject them to the same regulatory playing field, there's always going to be the differences that you as a credit union, this is your member, that mortgage transaction is one facet of a broader relationship you have with that individual. And you're not going to blow it up because of this one thing. Yeah. And, the fact is that lack of diversification, almost all of these non-bank mortgage lenders, all they do is mortgage lending. Whereas you may have a car loan with the person. You may have a credit card loan with the person. You have a much broader...
It's a whole suite of products.
Exactly. And you have a broader perspective on that person as a borrower. And so you care in a different way. And again, I think there are a lot of good people in the non-bank mortgage space. I really appreciate a lot of people in the industry who stood up. And again, so it's not about one specific individual. But, one of the things I reflect on in the book... while, of course, even at like a Bear Stearns or a Lehman, it's not like everybody there was at fault. This is their failures at the top. So I put that out there to say it's absolutely shocking how many countrywide people are still everywhere in the non-bank mortgage space. There seems to have been like zero reputational penalty played to anybody's career because of that one. And again, not everybody was at fault there. But the fact, and I just say this, is that the fact that there's no real reputational penalty to anybody's career with a small number of exceptions, and we saw that. And one of the things we were trying to change at Fannie and Freddie was trying to have a culture of responsibility. So the view at Fannie and Freddie really was, oh, well, the CFPB exists to protect consumers. That's not our job. And that, I mean, I'm a little harsh, but I'll certainly say as an aside, when I was writing the book, my editor at one point said, there are times where you're really complimentary to Fannie and Freddie, and then there are times where you're pretty critical. And I said, it's complex.
It goes both ways.
Yeah, and again, so the book is not really a cheerlead for anybody really, except for, of course, credit unions. But in all seriousness, I try to give, I think, a relatively even keel on Fannie, Freddie, the mortgage industry, many of the players involved and the regulators, and everybody deserves some degree of praise, and everybody deserves some degree of well, this is where things could have gotten better. And one of the things we really did try to change at Fannie and Freddie was the corporate culture, and to get them. So, for instance, one of the things I found frustrating was that you could be an account exec at Fannie Mae and have a non-bank mortgage lender as your client, and you could leave the next day and work for them. mortgage lender. Now that really was questions to me about, what's your incentive here? So, and how are we making it that Fannie and Freddie thought about the borrower as the ultimate? And again, the culture at those companies really was to see the lender as the client and not concerned about the borrower. And of course, unfortunately, they were both companies where many of the line employees did not feel like they had the culture to raise their hand when they saw problems. So I talk about a little bit of that in the book.
That's not a good place to be.
It's not, but to their credit, I mean, Sarah Matthews, who's still chair at Freddie, and Sheila Baer, who was chair at Fannie for a while, really embraced the corporate culture change and did a lot of survey work internally. And again, these are just too important of institutions not to have good, strong corporate cultures.
Absolutely. All right. So a couple of questions to round things out here. Now, you mentioned this before, reforming Fannie and Freddie and path out of conservatorship for the GSEs. Does that path seem less clear now? And where do we go from here? How might the GSEs fare in the next crisis, which will inevitably come?
It's a great question. So, I mean, I think the path in many ways is clearer, but on some margins, perhaps timing less clear.
Right.
So what I mean by clearer is, nobody, the kind of like Corker Warner, blow them up and take a blank slate and start.
We're not gonna see
that's
that
off the
happen.
table.
Right.
There's not going to be any Fannie Freddie go away. It's easy to forget that, even President Obama was like, Fannie and Freddie need to go away. And, so that talk is all gone. The question really is, what do Fannie and Freddie look like? And, will they get out of conservatorship? I think first of all, I should really emphasize, as someone who worked on the statute that created FHFA, the assumption is you fix them and you get them out. So this kind of endless conservatorship is not at all what the law intended. And I think that we were able to kind of change the conversation back to how are we fixing them to get them out? I think the current administration doesn't have a lot of interest in getting them out, but they're trying to do the dance of recognizing that they probably have some legal responsibility to fix them and move them along. I think, unfortunately, that where we may be in the housing cycle, that the next couple of years they are likely to go from pretty profitable to unprofitable. Oddly enough, or coincidentally, one of the silver linings of COVID was it really allowed us to reprice a lot of the Fannie and Freddie book. So pre-COVID, you still had a lot of surprisingly large number of like pre-2008 loans. And these loans were paying G fees of, 10, 15 basis points. So everybody obviously wanted to take advantage of those record interest rates. So you think about it, sure, the rates went down, but that doesn't really count for what Fannie and Freddie get. That flows to the investor. So we had a very large portion of the book where we were able to reprice the guarantee fee from something like 15 basis points to like 55. So we really put Fannie and Freddie in a much better cash flow position going forward. So for the loans that do perform and are in their book, they will have a much better cash flow position than they did going into 2008. I hope that's enough to avoid serious problems. But even that said, in all likelihood, if we do see some severe declines in the housing market, which I think we are likely to, it will stress the GSEs and, of course, will erode some of their capital. I've got my fingers crossed that it won't necessarily fail them because of what we did in terms of strengthening them. And that will delay any exit because you do have to raise the capital. You're also at a point where, you'd be at least a decade trying to retain earnings, get them to have sufficient capital. We had set them up, and I think if things turned out differently, we would have done a public offering of some sort, and I think raised enough equity to get them out. All of those plans are still, and they're still on the table. I mean, they're there on the shelf.
It doesn't seem like
there's not really because
much discussion of that.
I think the current administration looks at this and it's like, not a high priority issue, and obviously there's a lot of pressure back and forth. I mean, one of the stickler issues is that many of the larger bondholders, you think the PIMCOs and BlackRocks of the world, they don't want an exit from conservatorship without Congress providing an explicit guarantee, because their argument essentially is that the conservatorship hardens the guarantee, makes it, more explicit, less implied, if you will. Of course, that's not a consideration in the statute. I mean, you're still supposed to fix them and get them out. Whether Congress wants to create a guarantee or not, that's Congress's call. That really doesn't. That's not a statutory consideration, but obviously it's a political consideration. And I do think that the administration looks at this and says, a lot of people we're talking to don't want them to exit, and so I don't think you're really going to see them kind of be vocal about that they're not going to really move them toward an exit. I think they're just going to not talk about it.
Yeah. And years and years and more, decades go by where we don't have the sort of release that was envisioned, like you said, in the statute.
I think the thing that has kind of changed is that a lot of Republicans look at some of the things the administration has done is pretty aggressive, and have some concerns about the way Fannie and Freddie have been used, partly kind of as a bit of a cash cow. And so I think
a lot of money they've repaid their debt.
And so I think a lot of Republicans look at this and say you can't trust you can't trust a future Democratic administration with them in conservatorship. So who knows? I mean, I think the odds are high that there'll be a Republican in the White House again someday. And I think that we set a framework up when I was there that somebody coming in day one, because they won't have to wait. We had to wait 2 years because of Director Watt was holding over until that decision was made. But I think you would see any Republican administration come in and basically take the plan we had off the shelf. And I think within the first term of a Republican administration, barring big macroeconomic or housing market problems, I think they would restart the clock and they would get them out.
Sure. Yeah. Hopefully they can dust off that plan and figure out how to move forward quickly.
It's all there, and a lot of money was spent on coming up with some exit options. And let me say, from what we had a fairly, we spent a lot of time, and Fannie and Freddie did a lot of analysis. We did a lot of analysis. Treasury did a lot of analysis. It's all still there, and there is basically a plan that one could very easily implement.
Great. So let's talk about the housing market right now. Are we headed toward normalization of prices and housing supply? I mean, supply has been really low, and affordability.
Normalization is a great
affordability is a challenge for a lot of people. How long is it going to take for prices to normalize and for the market to cool?
So, I mean, first of all, let's kind of keep in mind that normally the housing market adjusts first quantity, then price. And so, as we've seen, sales have fallen off the cliff in terms of home sales. Construction has started to cool. And, obviously mortgage origination activity started to cool. We are only, in my opinion, very early in the adjustment process for prices. Now, there have been markets like San Francisco or Boise where, you've all but seen a crash in prices. So I think in 2023, and again, I'm probably more on the more pessimistic end of the range, but I think this next 12 to 18 months, we will see a pretty strong correction in prices in most markets, partly because of the affordability problems you've mentioned. You simply haven't seen the income growth to match it. You've also seen a huge pullback in investor demand. So, I mean, that there was a huge amount of 2020-21 purchases that were driven either all cash, and I mentioned this in the book, something like a third of people who were making down payments used their COVID relief funds and things like that. So you don't have all of that money flowing into the system. You don't have that record savings that was going on in 2020. So big pullback in demand.
I mean, consumer balance sheets are still pretty strong.
Yeah, by and large. And when I talk about that, when I have said that I think there are going to be problems in the mortgage market, it's not the median borrower. The median mortgage borrower is in great shape. It's really the 5-10% at the margin. And there is a worry there. I mean, I think we've seen, probably about 15 to 20 points of FICO inflation during COVID, where because of the suspension of reporting. So I think FICOs are actually worse than people think they are. The thing that really kind of concerns me in terms of big change in mortgage quality is the debt to income. One of the things we saw in COVID was the number one predictor of who took Fannie and Freddie forbearance was DTI. And the levels of DTI we see today are much higher than they were in 2008. So yeah, no,
That's concerning.
It is concerning. And you know, even FHA, you are allowed up to a 57 DTI. Even the typical FHA is like a 45. So you have a lot of borrowers that were they to lose their job. And again, this is the caveat here. It really depends on what happens in the job market.
Right.
If we start to see a softening job market, if we start to see a lot of job losses, then you're going to have about a 5% sliver of the mortgage market, concentrated mostly in FHA, but not exclusively, that's really going to have trouble. And I think that that's where we need to keep our eye. But prices will reset. At this point, I would say what we're likely to experience is more like a early 70s, like 73 to 74 type correction, where it's brutal for about 6 months, a year, but by 3 years, you're peak to peak again. The only way we're really going to get a sort of 2008 prolonged, because let's keep in mind, I mean, that was a painful decade. I mean, you know, really took forever. I didn't really feel like we were probably 2018 to the housing market really started to feel right again. So it really took a decade. Some of that was the policy response, as I mentioned earlier. I mean, a lot of the mortgage programs in 2008 penalized going back to work, and you had that very slow labor market growth. You had slow appreciation. So I think the caveat here is, what's the policy response? If we allow the market to reset, prices drop, you know, the volumes will come back and people will be able to reset at a level where the prices are much more in line with what they could afford in income. But I think the reset is inevitable. The question is, do we let it happen quickly? And I'm more on the just pull the Band-Aid off and get it over with camp. But I know that some people would rather not take that approach or feel like they could kick the can down the road. But again, I think we're looking at a 12 to 18 month process of realignment in prices. There will be certainly layoffs in the construction real estate cycle. The one probably area that I don't think gets enough talk that I am concerned about is, while I think in most markets we're still a shortage in the single family, we're building more apartment buildings today than we have since like the 70s. So I think that there's some pockets and markets in the apartment market where you've already started to see weakness in rents. And so that's a segment I'd keep a real eye on, that I think there could be some potentially problems on. You know, we all hope that the worst of inflation is behind us, but you know, and
the Fed is going to keep raising rates for a little bit. And so what's your prediction for mortgage rates for the year and going into 2024?
I still think we're going to have them for the rest of the year, you know, bouncing just above 6%. I mean, I recognize it's on the higher end. But you know,
relatively speaking, I mean, you know, you go back to the 80s,
historically,
it's
no. I mean, I think my first mortgage was 9% or something. I'm not one of those people old enough to have the 13, 14, 18% mortgages, but you know, again, at the grand scheme of things, that's not a bad mortgage. But that also means that prices need to reset to that mortgage environment.
Exactly.
So the first thing we need to accept is we're not getting back to 3% mortgages.
No,
that's not going to happen. So even were there to be a normalization, I think over the next couple of years, were rates to normalize, you're still talking around 5.5. And so, you know, we're probably not, we are years away from probably seeing anything even in the 4s, definitely not the 3s.
Yeah.
So again, prices are just going to have to adjust to that. We've also seen, you know, I mean, I didn't necessarily agree with these, you know, approaches, but the administration's approach has been to ease the credit box a bit, which has kept demand stronger than it would be otherwise. There's only so much ammunition in that before you run out, because, you know, functionally, you know, how high are you going to push LTVs? You know, how high are you going to push DTIs?
Yeah.
And so
be a limit.
And we're closely getting to that limit. So I think that has slowed the descent in prices, but I think the administration is getting to the point where they're out of bullets in terms of the credit box. And that means eventually the prices will again start to adjust. So I do worry about, but again, the thing to keep an eye on is the job market. Probably the most pleasant surprise so far we've seen is that historically, when you've seen this kind of fall off in construction and house sales, you've almost always been in a recession by now.
Right.
And we haven't. You know, and so I think a soft landing is a low probability event, but I don't take it off the table. You know, I think it's a possibility. we've certainly seen the rest of the economy be more resilient. But again, the Fed is committed to this. I mean, my own view is I think they should have started taking away the punch bowl, the second half of 2020. I think by June, July of 2020, it was very clear that we were in a fairly strong job recovery. I think they waited too long, but we are where we are. And Chairman Powell seems very committed to, not being the Arthur Burns of his generation. And I think he is going to bring this out, whether it's painful or not. So granted, the rest of the board is fairly dovish, as is much of probably about half of the FOMC. So he's going to get a lot of pressure to back off, but I don't see him giving in quite yet. So
Doesn't look like it.
Yeah, so I would expect us to continue to see the Fed have the foot on the brakes for at least another year. Eventually, I mean, I don't want to quite go as far to say that the Fed is consciously trying to engineer a recession, but they're definitely trying to engineer a reset in the housing market. And it's hard to get a reset in the housing market without getting a recession.
Yeah. Well, that does it for this episode. Thank you so much.
My pleasure.
And thank you, everyone, for tuning in to this discussion on the housing market and Mark Calabria's new book, Shelter from the Storm, available March 14th. Go get your copy. It is a riveting read. I really enjoyed it, and I highly recommend it to all of our viewers and listeners. And if you enjoy watching or listening to The CUPP, please give us a thumbs up, like and subscribe to hear about the latest episode, and also please send us your recommendations for future content and discussions that you'd like to hear on the next episode of The CUPP. We would love to hear from you, and thank you so much again, Mark Calabria. What an incredible discussion. Until next time.